So could a single trading pattern really make you $100 a day? That's the big claim we're digging into today. We're going to break down the exact strategy from the source material that aims to do just that. Let's get right into it. Okay, so the core promise here is pretty straightforward. The potential to make $100 every single day. And the whole idea is that if you can just master this one high probability pattern, you could potentially create a really consistent daily income stream. All right, here's how we're going to tackle this. First up, we'll get into what this pattern actually is and look at its anatomy. Then, and this is super important, we'll cover a couple of critical mistakes you absolutely want to avoid. After that, we'll check out some advanced strategies, and finally, we'll lay out the exact financial blueprint for trying to hit that daily target. So, what is this mystery pattern? Well, according to the source material, it's a pretty simple strategy, and it's designed to signal the very start of a strong trend. Let's take a look at how it works. They call it the 3-bar pattern, and really it's just a sequence of 3 specific candlesticks, those little visual bars that show price movement. When they show up in just the right order, it suggests a powerful move is about to kick off, giving a trader a really clear signal to get in. Okay, so if you're going to use this pattern, you've got to know how to spot it in the wild, right? It's all about identifying 3 distinct candles in a very, very particular sequence. So let's break down each one. So it all starts with what's called the igniting bar. Think of it as a big, powerful candle that shows a sudden burst of momentum. Right after that, you get a small pullback bar that's the opposite color. And here's a key detail. It can't be more than half the size of that first bar's body. Finally, you get the confirmation bar, which keeps going in the original direction and closes past the pullback. That's your signal. And this here shows you exactly how the pattern plays out in both directions. For a bullish move, that's an upward turn, you're looking for a green-red-green sequence. For a bearish or downward move, you just flip it. Red, green, red. See? The core logic is exactly the same, it's just inverted. All right, now knowing the pattern is one thing, but avoiding the common traps, that's what really separates the pros from the people who lose money. The source material points out 2 very specific and very costly mistakes that traders often make with this setup. Okay, mistake number 1. And this one is huge, forcing the igniting bar. That first candle is literally the foundation for the entire setup. If it's not strong, the signal is basically worthless. A lot of traders get into trouble when they start trying to see a pattern that just isn't there. Just look at the difference here. On the left, you see that first candle is kind of small. It just blends in with the others. That's a huge red flag. But on the right, the igniting bar is a monster. It totally stands out, and that signals high liquidity and real, genuine momentum. So the takeaway here is simple. Size really, really matters. The second big mistake is all about context. You might see a pattern that looks technically perfect, but if it shows up after the price is already shot straight up like a rocket, it's often a trap. Those kinds of crazy moves are almost never sustainable, and they can reverse just as fast as they started. And here you can see exactly what I mean. The setup on the left happens after one of those insane parabolic spikes. That's the danger zone. The ideal setup over on the right forms during a nice, gradual, clean trend. The key word here is gradual. You want to ride a sustainable wave, not jump on a rocket that's about to fizzle out. Okay, so once you've got the basic pattern down and you know what not to do, you can start adding some layers to potentially boost your odds. Let's jump into the advanced strategies and see how we can build on this. The first advanced technique is actually pretty simple. You just use an indicator to confirm the overall trend. The source suggests something called a 50-period EMA. It's basically just an average of the price over the last 50 candles. If the price is trading above that line, the trend is up, so you only look for bullish setups. If it's below, the trend is down and you only hunt for bearish ones. It's like swimming with the current instead of fighting it. All right, strategy number 2 brings in historical price levels. So imagine a bullish 3-bar pattern forming right on a major support level. That's an area where buyers have historically stepped in and pushed the price up. That's a much, much stronger signal. And the exact same thing is true for a bearish pattern that forms at a resistance level. These levels act as this extra powerful layer of confirmation. And the third strategy? This one is perfect for when the market is just kind of going sideways, not really trending. You wait for the price to actually break out of that boring range. Now, if a 3-bar pattern forms just as the price breaks through that support or resistance, well, that's an incredibly strong signal that a new, powerful trend is just getting started. So, We've got the pattern, we know the mistakes to avoid, and we have some advanced techniques. But how does all of this actually translate into that goal of $100 a day? Let's get into the nitty-gritty and look at the actual numbers that the source material lays out. But first, we need a crucial dose of reality. Look, the goal is not to win every single day. That's just not how trading works. It's a game of probabilities. The source really hammers this home. Consistency comes from having more winning days than losing days over the long haul, not from being perfect. Now, to realistically shoot for that $100 a day target with this strategy, the source suggests you'll need about $5,000 in trading capital to start. This is what allows for the right position sizing and risk management, which you're about to see is the key to the whole thing. And here it is, the core of the financial plan. With a $5,000 account, each trade you take is $500. Your profit target is a 20% gain, which works out to $100. Your stop loss is set at a 10% loss, or $50. This sets up what's called a 2-to-1 risk-reward ratio. It just means your potential wins are twice as big as your potential losses. Now, I know what you might be thinking. A 20% gain on a single trade sounds huge, right? Well, the source explains this is done using 5x leverage. What that means is a 4% move in the actual asset's price turns into a 20% gain for you. But, and this is a big but, it's a double-edged sword. A 2% move against you becomes a 10% loss. And this is how it all comes together beautifully. Let's say you take 4 trades in a day, and you only win half of them. That's just a 50% win rate. Well, the math still works out. Your 2 winning trades make you $200. Your 2 losing trades cost you $100. So what's your net profit for the day? $100. The key takeaway here is you don't have to be right all the time. You just need a really solid risk management plan. So we've walked through the pattern, the strategies to use, and the math behind the money management. The source definitely lays out a very clear blueprint, but it does leave us with a bigger question, doesn't it? While having a technical plan like this is absolutely essential, maybe the true challenge and the real key to success isn't found on the charts at all, but in a trader's own discipline to stick to that plan day in and day out.